It is a tremendous honor to introduce our first guest, William White. He is the chairman of the Economic Development Review Committee at the OECD in Paris. He's held that position since October 2009. Before that, he was the chief economic advisor at the Bank of International Settlements, the BIS, in Basel, which is the central bank of all central banks. He joined BIS in 1994 after having spent 22 years at the Bank of Canada and another 3 years before that at the Bank of England. So if there's anyone with an experience in central banking spanning more than 39 years, would you please raise your hands? William White, please join me in a round of applause for him. We will be holding a discussion, and I'll also open the panel for questions from you towards the end of our discussion. But if you do have a question, please raise your hands. Afterwards, there will be a microphone in the room, and I'd like to take as many questions as possible. The title of our talk is the cost and consequences of policy extremism. Now, Bill, looking at what central banks are doing today, be it the Fed, be it the Bank of Japan, be it the Bank of England, the ECB, even the Swiss National Bank, does this qualify as policy extremism? Have you seen anything like that before?
Well, I think the honest truth is no one's ever seen anything like this before. I mean, if you go back to the 1930s, for example, which was arguably not arguably, clearly, a much more difficult set of circumstances than anything that we've been facing. Interest rates never got anywhere near as low as they are at the moment. And then, of course, what we've added in is we've added in QE1, QE2, Operation Twist, forward guidance. All of this stuff is in a certain sense, brand new. So yeah, this is very, very unusual. And I would also add that if you look into the sort of the details of what it is that these big central banks are doing, what you'll see is that they've all been conducting their policies in a different way, okay? So that the experimental character of this is manifest in the fact that different banks are doing different things. They're making it up as they go along. And I'm very worried about any kinds of policies that have that nature.
Now, the circumstances in late 2008, after Lehman had failed and after the world economy kind of plummeted, didn't they call for such extreme measures? I mean, could I say that central banks really rescued us from something worse?
Yeah, absolutely. You remember at the time when after Lehman's, when all of the sort of the markets, the interbank market in particular, but many other markets just seized up. And the central bankers, I think, quite rightly said, we have to maintain the functioning of the system. And that's when they came in with the initial things that they did. And I think that was absolutely right as an instrument for crisis management. Okay? But I've always distinguished in my career between crisis prevention, crisis management, and crisis resolution. And crisis management is we're right in the middle of it. What do we have to do now to stop the implosion? Well, we're 6 years past it. We're 6 years past it, and they're essentially doing more of what they did right at the beginning. And I think there's something fundamentally wrong there. They moved, particularly in the United States, from the initial attempt to get the markets functioning again to a completely different motivation. And I can remember reading one of Ben Bernanke's speeches that he gave in New York and saying to myself, he's describing a completely different objective for what he's doing. It's no longer to get the markets going again. It's to buoy up the asset prices artificially, make people feel that they're wealthier, they'll spend money, it will trickle down, and the economy will get going again. This is a very, very different thing. And frankly, my view is, one, it won't work, and two, it's extremely dangerous.
So I could say that, yes, QE1 in November 2008, when markets had seized up, that was okay.
Absolutely.
But they should have left, or they should have stopped these kinds of policies long ago.
Here's the problem. When you talk about crisis resolution, it's mostly attacking the fundamental problems that got you into the problem in the first place. And frankly, the problem that we are all dealing with still is the problem of excessive debt. Now, if you're going to resolve the problem of excessive debt, whether through restructurings or write-offs or other policies that I could go into, these are matters for governments. Central banks can't rescue insolvent institutions. They can provide liquidity, but they can't deal with the problem of insolvency. That's for the governments to do. But the fact of the matter is that all around the Western world, and I include Japan in this, the governments have resolutely failed to see that they've got a responsibility to try to deal with the underlying problems. And the difficulty, as I talk about this, the unexpected consequences of ultra-easy monetary policy, is that the politicians want to believe that it will work, and therefore they don't have to do the hard things that would be required to really get us out of this problem. So it's a problem of governments. And the central banks are doing what they're doing because they don't see anything else that they could possibly do. But in the end, as I say, I'm worried that if we don't deal with the problem at its heart, we're going to be in worse shape, not better shape.
So what are the consequences and the costs of these policies?
Well, the first thing that I would worry about, I think, in terms of these policies is the asset prices. And I think you mentioned this a moment ago. Every asset price you could think of is really in sort of very odd territory. You look at the equity prices, you compare them, for example, Tobin's Q or Shiller's sort of, lagged PE, whatever. Prices look extremely high. The risk-free bond rates are obviously at enormously low levels by traditional standards. The spreads are very, very low. The sovereign spreads were very, very low. Cov Light. To me, it looks much like 2007. And frankly, I almost think it's worse than 2007 because in 2007, it was a problem of the advanced market economies. But now, in this intervening period, through holding these sort of semi-fixed exchange rates, all the emerging market countries, including China and India, they've imported all of the imbalances and the debt problems that we had in the advanced market economies. So now, they're all part of the problem as opposed to being part of the potential solution. So that's this whole business about the functioning of financial markets is one thing that really bothers me. The other one I've already mentioned is the governments have no incentive to act. A third one that I worry about is that we've got a lot of you're closer to this than I am, people in the financial area. We've got an awful lot of zombie companies out there and a lot of zombie banks. And I worry particularly about Europe, where the banking thing has been nothing but denial after denial after denial. And all the time that this is happening, with the interest rates so low and the banks frightened that if they write off losses, they'll go bankrupt, you just wind up evergreening everything. And the more you evergreen, the more you keep the zombies, pulling down the people that ought to be doing well. That lowers potential over time. So that's another whole... I wrote a 40-page paper at one point about the unexpected consequences of these sorts of policies. And honestly, I could go on and on and on.
So if we stick with asset prices for a moment, do you see real asset price bubbles out there again when you say it looks like 2007?
Yes, I do. Now, it may well be that, as I say, there's people that are closer to the markets than I am. I know that there's people who are respectable, who've got good arguments to support what they see as good fundamentals. Frankly, I really don't buy it. I think people are caught up in the momentum of all of the liquidity that's being provided by the central banks. And this is basically a liquidity-driven thing as opposed to a fundamental-driven thing.
Now, looking back, if we stick with the Fed, the US central bank, for a second, looking back over the past 25 years, hasn't that been pretty much the policy of the Greenspan-Bernanke Fed? Whenever something happens, provide liquidity and pump markets up again.
Yeah.
That was just the last chapter of a
Absolutely.
of a rather long history already.
Absolutely. And in a way, that's what's sort of so worrisome about it. Because if you go back to, let's say, 1987, remember the Greenspan put when the stock market came off in 87, and then again in 1991, and then again in 97, and then again in 98, and 2001 to 2, and now here we go again. This is the last of a whole series of these bubbles that have been blown. The difficulty is that in the past, it has always succeeded in revitalizing the economy. That as the asset prices started to go up, as credit became more available, the economy did in fact respond. But when you look closely, what you see is that each time the Fed had to act more speedily, more vigorously in order to get the same result. And then it's just simple logic to say, at a certain point, that which works less and less well, at a certain point, it's not going to work at all. And I fear that's where we're at. Now, can I just say, to make you feel a little bit better, I said this in 1987. I'm sorry, not 1987. In 1997, when we had the Asian crisis, and that was the fruits of the same kind of thing, too much easy money, too cheap credit, yields compressed. I said at that point, that's it. Okay, I was at the bits at that point. That's it. People have learned their lesson. That money is not going to go to Asia anymore. And it didn't. It went to Brazil. And it went to Russia. And then it's continued. But the underlying point is it's becoming less and less effective. And at some point, it's going to stop. And then I think we will be in big trouble. And we will have wasted many, many years in which we could have been following better policies that would have maintained growth in a much more sustainable way than the way we've done it.
Have you seen any indication that the Yellen Fed is any different from the Bernanke and Greenspan Fed?
Honestly, not really. One person that I must say was really, I thought, kicking up a real fuss and seemed to be having a big impact was Jeremy Stein, who's a professor of finance, I think, at Harvard. And he was going on about all of the unexpected consequences of this easy money, and in particular, the way in which asset prices were being completely disturbed, and he was very worried about it. And he seemed to have gotten the ear of a lot of people. But unfortunately, he's gone back to Harvard, because they have a policy, if you stay away for longer than 2 years, you lose tenure. And at his salary, I guess he figured that was a bad idea.
Now, when I look at financial markets, the Fed is in tapering mode now, slowly drawing down the QE3 program. Yeah. Financial markets seem to think that this will work nicely, smoothly. Basically, when I look at financial markets, the S&P 500 is at all-time highs. VIX volatility is very low. So markets tell us this will work out perfect.
But you've just reminded me about the VIX. Don't you forget that the VIX was at a record low in 2007 too. You know, all that liquidity does two things. It boils up, it raises the price of illiquid things, and it lowers the cost of getting liquidity insurance when you need it. So it's all part of the same parcel. I think that, sorry, could you remind me again? I got a little sad.
Basically, financial markets say this tapering thing works out perfectly.
It may, I think there's at least 3 scenarios, and probably there's dozens, right? But let me mention 3. One of them is maybe all of this monetary stuff will work. I don't think it's likely. I think we're at the end of the road. I could be wrong. I've been wrong so many times before. But it could work. And if it does work, then the long bond rates, the policy rates can go up, the long bond rates can go up, and there's going to be, in principle, no major problems. And all those other prices against a backdrop of faster growth, they're going to look much more sustainable. Maybe they're going to be a bit ahead of themselves, but they're going to look more sustainable. So that's the good news scenario. I also think there's a lot of reasons why, even against the backdrop of growth seems to be strengthening, that you might get a disorderly reaction in the financial markets, which would then feed back to destroy the very recovery that we were anticipating. And I can think of all sorts of reasons why that might happen. I mean, one of them is we're a long way away from normal long-term rates. If we're going to go back to potential 1.5%, 2%, and inflation 2%, that's one thing. Markets have this tendency to rush to the end point immediately, get there first. Markets always overshoot. I mean, Keynes said back in the 1930s that the long bond market could fluctuate at the wrong level for decades at a time, okay? So overshooting is entirely possible. The Americans have got this other special problem about convexity hedging. I've not looked into that at all closely, but at the level of principle, it's a big issue, driving the rates up more. If fears start to come back about inflation, another thing that will push it up, fiscal dominance. The States is not in very good shape on the fiscal side. And if people do start to worry about, well, in the end, it's going to be financial repression, blah, 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 people will again head for the exits. I think the regulatory changes, I worry about the unexpected consequences of recent monetary policy. But what about the unexpected consequences of recent regulatory policy? Okay? What about the fact that maybe most of the collateral that you need for normal trading is sort of all tied up? What about the fact that the big investment dealers now have got inventories that are 20% of what they were in 2007? Okay, so when things start to move, the market makers aren't there. They haven't got the inventory. And think particularly corporate bonds and things that are, pretty illiquid to begin with. So I think there's also, and lastly, and let me make this point too, lastly, this whole business about communication. Janet Yellen is on about communication, clear, transparent. My take on it is completely different. And I'll be honest, I've never spoken to a market person who hasn't agreed with me. When the Fed tells you exactly what they're going to do, okay, and you've got a carry like this is an absolute invitation to leverage. And all of these people, and I'm sure you're much more humble in this room, but I've met so many people who just are in the markets, particularly when they're making a lot of money, and they think they're absolutely brilliantly smart. And their attitude is, I'm going to see it coming and I'm going to get out first, okay? And that's what this clear and transparent communication is leading to. And when everybody heads for the exits at the same time, I think there's grounds for believing we're going to have an issue here. Now, I'm not saying 100% this is going to happen. All I'm saying is that reasonable people should sit back and think about all of these different factors that could lead to a disorderly outcome, even against the backdrop of faster growth. And if it doesn't materialize, the faster growth, all of those prices are going to be revealed as being way out of line with the fundamentals. And then I guess it's going to be sauve qui peut.
And when we look at at 5 central banks, the Fed, the ECB, the Bank of England, the Bank of Japan, and the Swiss National Bank, which of them do you think runs the highest risk of something going seriously wrong?
For me at the moment, what I'm most worried about, and I think I'm worried about Japan. And I know there's an expression, in London, they call the Japanese bond market the widow maker. Have you heard this expression? Because so many people for so long have said these bond rates are too low and I'm going to bet against it. And then they've all lost huge sums of money and their wives shoot them or whatever. The widow maker. The reason why I worry about Japan is that they're much further down the line even than the Americans, okay? Their problem started back at the end of the 1980s. And they responded with enormously easy money and with enormously easy fiscal policy. And it sort of worked. Masayaki Shirakawa, who used to be the governor of the Bank of Japan, has just got a paper up on the BIS website, which just came out 2 days ago, I think. And he points out the fact that real growth per capita in Japan has not been so bad. In fact, it's been higher over the course of the last 10 years in the US. And implicitly what he's saying between the lines is we don't need Abenomics. It wasn't so bad. Or otherwise put, I didn't do such a bad job. Okay, but now we've got Abenomics. Now the question is, what is it? Okay? As far as I see Abenomics at the moment, it's print the money and tell people that you're going to have higher inflation. I don't understand how it's supposed to work, but I can tell a very plausible story, to me at least, about how the whole thing's going to backfire. Think about your Main Street, Wall Street, okay? The guy on Main Street in Japan is going to say to himself, prices are going up, but my wages won't, because they haven't and they aren't, okay? So I'm confronted with a real wage loss, and I'm going to have to hunker down to buy food to put on the table. And Main Street's going to say, Wall Street's going to say, if we've got 2% inflation, it's a no-brainer. You know, the bond rates have to go up. I'm not holding bonds at this level. And then we have a double whammy, okay? Now, maybe or maybe not, the Japanese can keep it under control. But I think we'll get the double whammy, and then you're heading into deflation. And this is where we get back to a real problem that Peter Bernholz here has talked about in his last book. Here's where we get into a real problem, because now we've got a stagnating Japanese economy. Okay, the tax revenues are falling like a stone. The deficit is already 8% of GDP. Okay, it is well over 50% of expenditures. The debt is 200% and counting of sovereign debt. I have no difficulty, maybe Peter will talk to this a little later on, I have no difficulty in seeing this thing tipping like this overnight into hyperinflation. And when you go back into the history, as Peter knows, a lot of hyperinflations in fact started with deflation, and then the governments having to do what they had to do in order to keep the government functioning. So that's my may never happen, okay? But that would be my biggest worry at the moment.
Now, looking at how many central banks have expanded their balance sheets over those past 5 years, there have been many people warning of an inflationary future, even hyperinflation, and at the same time, we don't see anything. We might see asset price inflation, but consumer price inflation even dropping almost everywhere. So, I mean, is that fear overblown of sort of traditional inflation?
Well, let me say a few words about why we haven't got inflation on the basis of what the central banks have already done. Going back to what I said earlier, I think the reason why we haven't seen inflation, first of all, is because monetary policy is not working. That is to say that the signals from monetary policy, you know, higher asset prices, lower interest rates, etc., may or may not be getting through. But what is clear is that the consumers and the corporates are not responding to the signals, okay? So everybody's scared, everybody's sort of hunkering down, nobody's doing anything very much. And so if we started from a position where we had the actual interest rate well above the natural rate, or put it otherwise, the actual level of demand was below potential level of supply, that hasn't changed. We still have a disinflationary gap. Another way to look at it is to sort of say, there's been a huge increase in base money, okay? If you want to go back to sort of MV equals PT, there's been a huge increase in base money, but it hasn't translated into an increase in the broader aggregates. They're still going nowhere. And in Europe, of course, I mean, the money supply is still shrinking by various definitions. So that's why we don't have any inflation. My worry, to go back to the Japanese case, would be that at some point, people will look at the situation and really lose their confidence that stability will be maintained. And if they do, and they do start to fear inflation, that shift in expectations could have very major and very rapid increases on the actual numbers themselves. So we haven't seen it yet, but it's entirely possible we will see it.
Now, when looking at by how much central banks have increased their balance sheets, in relation to the GDP of their home country, the most extreme has actually been the Swiss National Bank in their defense of the one-sided peg, if we should call it that way. Should we in Switzerland be worried about that bloated SNB balance sheet?
Well, I know I'm not going to say anything bad about the Swiss National Bank because I know Thomas Jordan and he's a very, very big guy. I think you should be concerned, but I would remind you that this, in a way, is a different beast from what you're seeing in other countries. Because what the Swiss National Bank has done is they've not increased base money because they want to see the implications for demand and whatever. They've done it specifically to peg the exchange rate. And that decision was not a Swiss National Bank decision. As you Swiss people, you know this better than I do. This was very much something that was done jointly with the government in the interest of preventing the exchange rate from rising to a level where you would have really important implications for employment in Switzerland. So this is not just a Swiss National Bank thing. Up until now, they've done extremely, the vigor with which they have done this has really forced the speculators to turn around and go away. And I guess I would say that barring some really major shocks outside, that what they've done has probably been the right thing to do, and it's been very successfully implemented. But you cannot deny the arithmetic that the balance sheet is huge, much of it is in foreign currency, and if something bad happens outside and Switzerland once again starts to look like a refuge, and people are saying, I don't care if the exchange rate's at 120, I'm heading for Switzerland, then the pressures obviously will start again. But let's be hopeful that that kind of thing doesn't happen.
But during that, while that policy is in place, it's probably fair to say that here domestically in Switzerland, we have a too low level of interest rates right now, which leads possibly to asset price bubbles, the real estate market, credit bubbles. What do you see there? The SNB is worried about that.
Yeah, absolutely, and they should be. I just came back from Washington last week, where I was asked to summarize a one-day meeting on capital flows, capital controls, macroprudential instruments, and emerging markets. And it's exactly the same issue as the one that you're just asking me about, which is that exchange rates don't behave very well, and they never have done. So that the theory of uncovered interest parity, where they go up a little bit and then they look overvalued and then people sort of bid the price back down again, doesn't work that way, anywhere, and it never has. So you can get these long movements and very powerful movements into exchange rates. And then the country, wherever it is, whether it's Malaysia or China or Switzerland, then you're caught between a rock and a hard place, because the exchange rate is going up and you don't like it. Right? But one part of keeping it from going up is having easy monetary conditions, and you don't like that either. So you somehow got to try to find a balance or get new instruments. And the Swiss National Bank, and again, I'm not a great student of what's happening in Switzerland, but my understanding is that they've started to take measures of what I call a macroprudential nature, which is basically to say the real problem is housing, and somehow we've got to find a way to cool off that particular market. And that's not so silly because honestly, housing tends to be the big thing that goes wrong when you have these very easy financial conditions. Actually, even much more so than the broader financial markets. Housing is always an issue.
If there are any questions from the audience, please raise your hand and we'll get a microphone to you. Bill, you mentioned that basically what central banks did over the past 5 years was buying time.
Yeah.
Buying time, but not really tackling the real underlying problems. Yeah. And you also mentioned the big underlying problem is too much debt in the system. Not only government debt, but private debt in general. So how should we tackle that problem? How do we get that debt to go away?
Well, how can I say? What I'm going to recommend now is something that I wish governments had done in 2008 and 2009, because then the chances of them being effective might have been much greater. So the honest truth, it's going to be much more difficult now to do the right thing. I often say that there are a number of things that can be done, and some of them would please Keynes, and some of them would please Hayek. And the Keynesian things, if the G20 had got together in 2008, and they basically had said, who's got room for maneuver? In the interests of us all, we have to use it, okay? And that would have been China and India and a large number of emerging market countries who then still had relatively low inflation, and they didn't have the kind of debt problems that they've subsequently accumulated. That's what they could have done. And I think there's still some room for maneuver today. This may be, what's the word? You may think it's, heretical. I think in a lot of countries, the wage profit share has gotten completely out of whack. And that one of the reasons why the consumers are not consuming is because the wage bill is too low.
Does that include Germany?
I would certainly say so. I would certainly say so. So it isn't just fiscal expansion. There's other things that governments can try to do to increase aggregate demand. I guess the second thing that I would recommend is an awful lot more public investment. Even in places like Germany, I read that bridges are starting to fall down. You know, the last big expansion was over 20 years ago in Germany. You know, trains, blah, blah, blah. And it's much, much worse in many other countries. I mean, there's so much room for public expenditure on infrastructure. And what I don't understand, and maybe it's just me, I don't understand why governments can't convince financial markets that if you've got an asset, okay, that's a socially desirable asset with a rate of return, it's a very different thing for a government than to have bigger debts, but no asset to go along with it. It's a very different beast, and I don't understand why they can't sell that. So all of that stuff would please Keynes. On the Hayek side, I think the first thing is looking at the debt again. In many instances, the money is gone. I mean, I'm sorry to say this to pension fund managers and others, but you know, if you've made bad loans in the past, you bought bad securities and the money's gone, it's much better to write it off and get 50% than to pretend it's there and in the end get nothing. Okay? I mean, we've all known this from time immemorial. So more debt reduction, more recapitalization of banking systems, more facing up to reality. Okay? That, I think, would please Hayek and the Austrians. And the last thing, which would please the OECD, for whom I currently work, at least part-time, all of these structural reforms. I can tell you as the chairman of the Economic and Development Review Committee, there's just so much low-hanging fruit out there. If governments were prepared to take on the monopolists and the oligopolists and the unions and product market reform, labor market reform, so much that could be done. And it would have a really appreciable effect on growth, and of course, faster growth, greater capacity to service debt. So that's what I would suggest, but I wish it had been done 5 years ago.
We have a question from Professor Bernholz.
Bill, you are not surprised that I broadly agree with you, I guess. I have only one question to your remark in the beginning. I agree with you that the central banks had to give all the help necessary to prevent the breakdown of the money markets and so on. But I am still convinced that Sir Walter Bagehot was correct when he said, you should do this, but at a penalty interest rate, but at the same time evaluating the assets at the prices of normal times and not of the crisis. And we have here in Switzerland at least a perfect example how right he was. All the assets of the UBS have been sold with a profit after time, you see. And I think then also the problem of moral hazard would not have happened.
Yeah. No, I agree with Peter. And the moral hazard thing, honestly, I've written papers about this in the past, and the fact of the matter is, if you've got 20 or 30 years of every time there's a problem, the central bank or the government bails you out, either directly or indirectly, and the bankers come to appreciate that fact, then we are back into a world where they get all the profits and the government socialize all the losses. And then it just gets worse and worse and worse. And I think that's where we've got. And I think in terms of reining in the financial system, my own sense is that virtually all of the stuff that's been done up until now, while very useful, Basel III and all that kind of stuff, is not going to be sufficient to really deal with the moral hazard problem. And I guess I would like to see, or would have liked to have seen, a return to limited banking, a return to private ownership, a return to people going to prison when they do bad things. We're starting to see a bit more of that, but it's a long way down the road. I think moral hazard's a real issue.
We have to draw to a close here, but in order for us not to be depressed for the rest of the evening, give us your optimistic note on why it'll work out okay for all of us.
Well, the OECD and the IMF are currently forecasting. You may have seen this morning, they've been revising up their forecasts. So there are some momentum things out there that in the short run will be helpful. We know that we've had an enormous amount of monetary stimulus and that there are lags, and it is entirely possible that maybe those lags will come through. And in addition, we know that if the central banks need to do more, Mario Draghi and Jens Weidmann and Mr. Karuda are prepared to do more. So maybe we've got some push from that as well. We have promises of structural reform, major structural reform in China, in Japan, in Europe. So all of these things are to the good. And secondly, I mean, if that's just sort of about today, if you go back in history, and I've got lots of old books at home because I'm getting old, Gottfried Haberler's book on prosperity and recovery, which I think he wrote in 1939. And he talks about two things, and they're very, very powerful. One of them is depreciation, and the other one is technology. And on the depreciation side, investment has been enormously weak in the advanced market economies. Capital stock, I think, has actually been falling in the United States. We've got to be getting close to a time when people have to say, who are running corporations, I'm either in this business or I'm not in this business. And if I'm in this business, I'm going to have to take that pile of cash that I'm currently sitting on, and I'm going to have to invest it. And I think it's entirely possible that that might be coming down the road. Second thing is just the technology. Just because we've got a tough patch in the economy, it doesn't mean that smart people are not off in garages someplace doing the kind of stuff that Bill Gates and others were doing, okay? And the question is whether those people, whether we can find a way to get the money to those people who got the new innovations, you know, wherever it might be, you know, nanotechnology or solar, green energy, whatever, to allow them to get us onto a different investment path that actually might have the potential to push us onwards and upwards. So I know I tend to come across pretty negative, and I am very worried about the things that are out there. But I'm glad you asked that last question, because you can also tell a positive story. And maybe, as it were, tonight before you get your dinner and your drinks, focus a bit on the positive side of things.
Thank you very much, Bill White.